Fibonacci is actually the name of a person. Okay. And this person lived many, 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 many years ago, way before there was anything about online trading, online finances, and our Italian gentleman came up with what's called the Fibonacci sequence. This Fibonacci sequence is seen all over the world. It's not for the financial markets. It's a very easy sequence, except it goes on forever and ever and ever. But it starts out with 0. If you add 1 to 0, what do you have? You have 1. You add the two previous numbers together, which would be 0 and 1, you put a 1 down. You add the 1 plus the 1 you just got together, you got 2. You had the 1 plus the 2, you got 3. You had the 2 plus the 3, and you got 5. And this goes on forever and ever and ever. And this gives you what's called the Fibonacci sequence. Well, these sequences then have been added, divided, subtracted, multiplied, and there is a formula that I can give you. But they've come up with several of the most prevalent values of dividing the previous number by the current number, or going 2 digits farther and dividing that number by the previous number. And every time you do that, you'll either get 61.8, 38.2, 50%, even though we use it in Fibonacci retracements, is not a Fibonacci number. You get 61.8 or you get 71.6, which are what we call Fibonacci retracements. They are derivatives of the Fibonacci sequence. Now, this Fibonacci sequence has been applied. We see it in old Greek architecture. The Parthenon and all Greeks all was based on Fibonacci numbers, the Fibonacci sequence. We see it in the ratio of the snail, the spirals in a snail shell. We see it in the galaxy. There's even some truth to it that if you were to take some division between the nose, the mouth, the face, and apply the Fibonacci numbers, they would apply. And the more accurately they meet the Fibonacci sequence, the more beautiful the person is supposed to be. And it really is, the closer your eyes, nose, and mouth meet these Fibonacci, it's not makes you beautiful. It makes those numbers balance your face and make you, the word shouldn't be beautiful. It makes it more comfortable to your eye. Okay. So Fibonacci numbers appear all over the place. It wasn't until, just a couple of years ago that they started getting applied to the financial markets. And these ratios, which we now call the Fibonacci retracement numbers, are the most prominent ones. There are many, many, many more, because you can divide those numbers out forever. But the most prominent ones, and the ones that we use for our trading, are 61.8, 38.2, okay, 23.6, 78.6. And then, like I said, 50% is a very popular retracement number, and it's not part of the Fibonacci's. But because it's such a popular retracement level, it's been added into the Fibonacci tool to drop these on our charts. So what we believe, or what we've proven out in trading, is after an advance in a particular direction or a trend line or trend, an asset will tend to retrace itself 38.2%, 61.8%, or 62%, or stop at 50, or stop at the 50% level. And these are just levels where the traders seem to regroup themselves. So remember, it's based on this sequence: 0, 1, 1, 3, 2, 3, 5, 8. Okay, you don't need to know this sequence. There's no memory. You couldn't memorize. It goes on forever. Okay, but remember, 0 plus 1, it gives you 1. 1 plus 1 gives you 2. 2 plus 2 2 plus 3 gives you 5. And it goes on forever. And then this sequence is put together into this mathematical ratio, okay, that will give you these numbers. So not hypothetically and realistic, and you'll never have to do this, but if you were to take some of the numbers out of the Fibonacci sequence, so if we were to take 21 and divide it by 13, why 21, 13? No reason. We're just taking them because we take any of these two numbers that are next to each other and divide them by each other, we're going to get 161.53, or we get 161.9, 161.7. Okay. This number is important in Fibonacci. It's not a retracement number, but if you were going to go and the asset was going to continue up, it might help you set your profit point. If we were to go down and reverse that, take the 21 and divide it by 13, which we did here, and take the 13 and divide it by 21, we get 0.618. If we were to go one digit farther and get 21 divided by 34, we get 0.6176. If we were to go all the way back on the sequence and take 233 and divide it by 377, we'd get the same thing. Now, if we were to go one step farther and instead of using, say, hypothetically, the 21 and 13, we would take the 13 and we would skip the 21 and go 2 digits away and take the 34. And if we would take 13 divided by 34, it's going to give you 38 too. But if we were to go way farther down and take the 55 and divide it by 144, which are the two numbers next to it, you'd get 38.19. So that gives you the 38.2 retracement level. And if we were to take the 38.2 and the 61.8 and add them together, what do we get? We get 100%. Now, if we were to go one more digit and we, instead of taking the 1321, instead of taking the one right next to it, which would be the 13 and the 34, but we were to skip another number to go 3 digits, 3 numbers over, divide it, we get 0.236. And that gives us our 23.6% retracement. And that goes out to eternity. So these numbers do have some sense. They just weren't invented. They weren't just made up, and they're not flexible. Now, in real life, the 1.681 is called the golden ratio or the golden mean, and it's called phi. And the inverse of 161.8 is 0.618. This ratio can be found throughout nature, architecture, art, like I mentioned before. Okay. So none of this was ever developed for the financial markets, but it holds true. Now, we know in finance that an asset will tend to push itself up, ease back down, push itself back up. Okay. We could go on this forever, but this is the way an uptrend or downtrend works. Push, ease, push, ease, push, ease. Okay. We found by checking these thousands of times that when we get these push and then the ease and then the push again, the asset tends to retrace itself 38.2% of its prior movement, or as much as 50% of its prior movement, or as far as 61.8. Now it could push itself all the way down to 78.6, which is another Fibonacci, but that's way towards the end. Okay. Now keep in mind again that this number, the 50, doesn't come from Fibonacci, but it's on the retracement. So the levels we look for is 38.2, 50, and 61.8. We do have 23.6 levels, which are very, very shallow. They happen quick, and they don't help us much in our trading. Just like 78.6. It's so far down, it's almost back at 100% retracement. They work, they hold true, but there's a common place where traders tend to psych themselves out. Hold on, let me get these lines off our charts here. Okay, so we have something called a Fibonacci retracement tool. This retracement tool makes it easy for us to put these on our charts. Now, in order to find the Fibonacci retracement levels, now think of these as a different type of support and resistance levels. Now, in order to use the Fibonacci tool and put these levels on a chart, you have to find, and this is important, the recent significant swing high and swing low. Now, you're using the prior movement. You're not using the current trend or the current movement of the asset because it's happening now. So you need to find the trend that has ended, whether it's an uptrend or a downtrend. And then you find the significant high and the significant low of that movement. And the reason I use the word significant is a lot of times an asset will peak all the way up for 1 second, okay, or peak all the way down for 1 second, and it looks like that's the number that was the end of the trend, but it's not a significant swing high or swing low. The better you pinpoint the swing high and swing lows, the better and more accurate your tool will be. So for downtrends, we would then take the tool and click on the swing high and drag it down to the swing low. For uptrends, we do the opposite. We click on the tool and drag from the swing low to the swing high. So let me pop up some live charts so you see what we're talking about here, because I know it's hard to vision all this. Okay. So this is just my standard teaching chart. Now I'm going to turn off the fib. Let's see. I'm going to actually delete it. Now, we see the price has moved down here in a downtrend. Okay. The problem is this, you could hypothetically say this is your downtrend, but it isn't. If you were drawing a trend line and looking at an actual trend, this would have been your trend, because here we went into sideways movement and now we've continued down. So even though the prices continued to fall, this would have been the end of your downtrend here, because then you moved into a sideways trend. So in order to use the Fibonacci tool, you would go over here to your tools, find your Fibonacci retracement tool, and then click on the significant high and the significant low and drag it down. Now, it's not going to help us here because this was the downtrend. We never went into an uptrend. So it's not helping us here, and you can't extend it out here. So you might have wanted to go back farther, but that's besides the point. Now what we have is our Fibonacci levels added to our charts. So we can see 0, 23.6, 38.2, 50%, 61.8, 78.6. We didn't do anything. It's not complicated. Now, if we were to go to our Fibonacci tool settings, we could decide what levels are important to us to look at. Now, remember when I said 161.8? That's called a Fibonacci extension. That's the other side of the Fibonacci level where you might, that's when it's gone past 100%. So that's where you'd be projecting to where your profit would be. But you can decide which levels you want. 78.6, a lot of traders don't pay any attention to. 23.6, a lot of traders don't pay any attention to. So we can take them off. We can colorize it. We can stylize it. We can do whatever we want. Now, you also have the ability to project these lines all the way to the right, and they'll constantly be going to the right. You could extend them backwards to the left also, but I have no use for that. Okay. Now, the fact is, once this trend is over, these levels really have very little importance to you anymore. Except some people like to overlay their previous, they will put their chart, their current Fibonacci retracements on. And if they happen to overlay existing previous Fibonacci levels, they add a little bit more sequence, a little bit more value to that number. So as you can see, these are all dragged forward for us out into the future, just like a support and resistance line. So they're not so complicated to get on your charts. But once you have them on your charts, you have to figure out what you want to do with them and how you're going to interpret with them. So as you can see in my little example here, we have the ways to draw the Fibonacci are very, very easy. Okay. And we have 3 different examples here. And it's just pulling from the swing low to the swing high, or the swing high to the swing low, depending on which way your trends went. But then once you have them on your chart, it's how do you interpret them? Well, I'm a big support and resistance trader. Okay, so my charts always have my support and resistance levels on them. But when my eyeballing support and resistance lines happen to overlay a Fibonacci, or they're very close to Fibonacci, it gives me a more defined point or a better zone to be interested in. It helps define my support and resistance levels. Now here we've used extensions also to see how far down that price came. Now, as you can see here, when price is moving up, and Fibonacci's really only help us in an uptrend or a downtrend. When it helps us understand the waves and the retracement levels. Okay. The most easiest way I explain it in most of my classes, it takes a lot of work to be in an uptrend or a downtrend. When price starts to move in one of these trends, there's a lot of traders pushing in and slowly pushing up that market. As they push up the market, more traders are jumping into that market, and more trade. And it's like a hamster on a wheel. Once that wheel starts turning, it's difficult. It doesn't take much energy to keep it going. But there's a certain price in that movement, in that wave, that a lot of the initial traders who jumped in there and started that wheel turning, I say, you know what? I'm taking my profit. It went to where I go. Because a lot of people, like myself, I set a target level for each trade. I have set it up and exited the trade. Now I can extend it farther, but I can also open another trade. I want my trade to be exactly what I determined before I entered the market. Or a lot of buyers, they're in the market or sellers, and they say, I've made my profit. I don't think it's going any higher. I'm going to sell. Also, to a lot of people that aren't in the market, they're saying the price has gotten too high and they sit on the sideline. At some point, that price is going to retrace. That price is going to come to a point in which the guy sitting on the sidelines say, that's a good price. I'm going to enter the market. It's also all the sellers that were closing out their positions say they're all closed out. So the market stopped easing back down. And now the traders that are on the sidelines start entering back in. Now that could be at a 38.2% retracement, a 50 or a 61.8. But because these numbers are so well known that they support themselves. Also, like I said, if these numbers happen to fall right over top of a support or resistance area that you had on your charts already, they also will help. And that's where okay. Now, if you're in the market, you want to already set what you think the retracement would be, that you're not going to jump out of the market. Because if you entered a trade here and you thought it was going to go to here, you don't want to panic every time it takes that ease. Remember, the market is push, ease, push, ease, push, ease. Now, there's all kinds of wave strategy, market cycle strategies. We're not going to talk about that. Okay, they're not fib levels. But if you believe that the market, an uptrend or a downtrend, most of the time the market is trading in a sideways congested mess, or price could be moving up, but not something that's interpretable. When you're trading, you should be trading in a well-defined uptrend or downtrend when the market is making, what do we call, higher highs and higher lows. What's the higher high? Market pushes up, makes a higher high. What's the higher low? It stays above the previous low, moves back up, eases back down to make another higher high. Okay. So you want to make sure that you're not panicking and jumping out of a trade when it's simply doing that ease. Okay. So 38.2 would be a good position to say, I'll let it ease back down to 38.2. And if that combines also with the previous lower high, lower low, it supports itself. You might want to say 50%. At some point, you have to say, okay, I need to get out of this market. You'll never get out at exactly the right point. You'll never get in at a 61.8 or a 38.2, but it helps you set your goals. Hold on one second. Let me get my PowerPoint back up here. So once we have our Fibonacci's on our charts, think of these levels as alert zones. Retracement levels alert traders or investors of a potential trend reversal, a resistance area or support area. Retracements are based on a prior move. A bounce is expected to retrace a portion of its prior decline, while a correction is expected to retrace a portion of its prior advance. Once a pullback starts, charters can identify specific Fibonacci retracement levels for monitoring. As a correction approaches these retracements, you can alert yourself to see if that bullish trend is reversing or continuing on. Now, keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It's at this point that traders should employ other aspects of technical analysis to identify or confirm a reversal. These may also include candlesticks, price patterns, momentum oscillators, or moving averages. A Fibonacci retracement is not an individual signal. It's not an individual analysis tool. It's a tool that's feeding you information. It's telling you levels of importance or prices that are important in the journey of that asset. So you can use them to help define entry and exit points or where to put your stop losses. So using the Fibonacci stop loss approach is especially interesting because it offers a more objective way of placing stop losses. A good way to place your stop loss would be to find the next level in the Fibonacci sequence below where you'd be entering the market and place your stop loss at that, slightly above or below, depending on which way you're trading, that level. Once a trader has drawn his Fibonacci levels, they don't move anymore. And that's the nice thing. Fibonacci levels are fixed levels. And the stop loss potential levels are well defined. In this example, the trader drew the Fibonacci tool during the downtrend and then used the retracement levels on the right to trail his stop loss. The trade exit happened once the price failed to move to the next retracement level. Stop loss below the level. As the price is moving up, he's moving his stop losses up. When price fails to break above the 23.6 level, closes out his position. Now, you might say, okay, I'm going to enter this market. I'm going to wait for a certain price point to enter the market. Maybe you said when the price bounces up the 38.2 level or breaks that 38.2 level. And then you can place your stop loss beyond the next level, which is the 50% level. So now if you want to mitigate your risk, another way to set your stops would be to place them past the most recent swing low or swing high. But the truth is, just like in combining Fibonacci retracement tools with support and resistance trend lines and candlesticks to find a better entry, it would be better to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss point. As much as possible, you shouldn't rely solely on Fibonacci levels of support and resistance points as the basis of a stop loss placement. Remember, stop loss placement isn't a sure thing. Now, how would you use the Fibonacci retracement tool to enter a trade? The first thing you should know about the Fibonacci tool is that it works better when the forest market is trending. My personal advice is it doesn't help you at all in the sideways movement. So the idea is to go long on a retracement at a Fibonacci support level when the market is trending up, or to go short on a retracement level, a Fibonacci resistance level, when the market's trending down. So let's assume that we have found an uptrend. We have to wait for a correction to enter a long position. Correction is shallow, only at 38.2 retracement line. We go long, and now there's a question when to close the trade. Many traders follow the rule that the move up from the 38.2 retracement may end at the 138.2 extension. Remember, the extension is the one step past. So 161.8, 138.2, 123.6. And the saying in the market, and I don't trade extensions, so I can't tell you by personal use, is take the retracement level used to enter the market and then used in the extension level. The extension level is always past the 100. So in this case, since you entered at 38.2, you set your target point with the 138 extension level. That's why I showed you in the setups that you can change them. When you're placing an exit, it's a good idea to place it just before the level you are planning to exit at. You should practice it yourself, and maybe better to place exit orders a few points earlier than the exit level. When you are placing an exit order, it's a good idea to place it just before the level you plan to exit. You should practice it yourself. Okay, all of this is just guidance and information. And there are two reasons for that. Sometimes the price will not touch the extension, like in the previous example. It may miss it by just a few points, and it will still be a valid move to the Fibonacci extension level. Another reason is that when the price reaches a certain extension level, you are not the only one trying to trade that exit. So lots of people are trading that exit line, and so the market is, swinging down. So you don't want to miss the point. The price might just touch that line and move back fast, and your close orders may not be completed. Sometimes the price will not touch the extension level. So you want to use them as general guidelines, alert zones, not exact points. So we could use the standard three-part rule. Three-part rule is enter whatever retracement level you want to enter. Use the extension rule to get your extension. And this is the way that I trade a great deal, as my exit strategy, which you should have. But when I enter a trade, I will close part of my trade at a certain profit level. I will then close another portion of my trade at and I'm constantly moving my stop losses up, and then I'll let the small little part of it ride out individually. So if I were to have a $10,000 trade, a $10,000 trade, and 10, all on the euro, okay, and the euro moved in my position. Once it moved up to the to my profit, my first profit target, I closed out my 33% of my trade. Okay. I've already locked in my profit because I've already moved my stop loss up to that level. And so even the market falls back on me, I made the profit in that move and I'm gonna get stopped out. Second part, I'm putting more profit in my account. Third part, if it reverses, I'm still protected because I've moved my stop loss up in 3 parts. So we might want to use this by combining the extension levels to set these levels at. And then 78.6. 78.6 is one of the steepest Fibonacci retracement levels. But if you firmly believe that the asset you're looking at is in an uptrend or going to trade up or down, whichever, okay, 78.6 can be looked at as a bargain basement. It's, that closeout store where you can find the designer clothes at 75% off the market, even though they might be 6 months old fashioned. When you wear it to a party Saturday night, everybody say, "Look how good you look." Okay. So imagine yourself in a store, a salesperson, all of a sudden, all the goods are available at a 78% discount. Guess what? Buyers will start jumping in and push the market back up. Now you have to firmly believe that the market is going to continue its trend. So 78.6 is it. There's a whole set of strategies that might go to 78.6. We also have an 88.6. To me, I very rarely trade a 78.6. Okay. And I sure wouldn't go beyond that. But remember, Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move, while short 23.6 retracements do occur. The 38.2 to 61.8, 38.2, 50, 61.8 cover more possibilities. This zone may seem big, but it is just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. So remember, if you do have any questions, please type them in the screen and someone will get you an answer. But remember, Fibonacci is just another way of putting support and resistance levels on your charts. So think of it. It's an easy way to do it, and you get the most current numbers, and they fall over top of your already existing support and resistance levels. It ups the importance of that particular price. So thank you very much for joining us, and have a great trading week. Best luck. Bye now.